Well, it was another solid week for financial markets last week. The S&P 500 notching its longest daily winning streak since all the way back in 2004, while havens such as gold faced fairly chunky headwinds amid what was a broadly more positive and conciliatory tone on trade out of the United States, and also a solid slate of Magnificent Seven earnings as well. Turning to the week ahead, another busy docket awaits, including four G10 central bank decisions, highlighted, of course, by the FOMC on Wednesday, and then a likely dovish BoE decision on Thursday lunchtime. Plenty else going on besides, leaving us with lots to discuss on the trade-off this week. So without further ado, let's crack on with the show. So busy week for markets last week, looking to be another busy week this week. Joining me as always to try and make sense of everything that's going on is my good friend Ryan Littlestone from Forex Live and Forex Analytics. Ryan, a very happy bank holiday Monday afternoon to you. I'll just get that in. If the powers that be at Pepperstone are watching, then please do take note of this level of commitment. And I thought I'd film from home today to show off all the Arsenal memorabilia in the background, just to give you an idea of what a proper football team looks like.
Oh, right, yeah. All three things there, are they? Was that the last?
There's more out of shot.
Wins. Yeah, well, yeah, lots of stuff here. You can't see my European winning photo that's behind the green screen behind me. So, yeah, maybe one day you'll have one of those.
Yeah, maybe, although I'm not sure football's the best subject at the moment after what we did against PSG last week and then what happened against Bournemouth over the weekend. They are firmly in my bad books at this moment in time.
Yeah, not mine.
I bet. Right, let's crack on with the show, shall we, and get into topical thunder. So plenty of places we can start today, but I'm going to kick things off with a look at the jobs numbers that we had out of the United States on Friday. And all in all, it was a pretty solid jobs report, to be completely honest with you. Headline non-farm payrolls rising by 177,000 in the month of April, well above the consensus 135,000 figure, and also topping the Bloomberg forecast range, well above my own guess of 130,000 as well. So no matter how big a bribe I pay you this month, Ryan, there's no chance of me winning that sweepstake you were running. We did have quite a chunky downward net revision to the prior 2 months of data, though, minus 58,000, not the best, dragging the 3-month average of jobs gains to about 155,000. So as near as makes no difference, in line with that break-even payrolls pace. In terms of other bits and bobs, average hourly earnings, they rose by 0.2% on the month, which saw the annual pace remain unchanged at 3.8%, while unemployment, that also held steady at 4.2%, despite labour force participation rising to its highest level since January of 2020. All in all, a pretty solid slate. And if you didn't have an orange bloke in the White House throwing tariffs around aimlessly, then we'd probably be sat here using the word Goldilocks, talking about how the labour market remains in very, very rude health indeed. But of course, we can't really do that this time around. There are significant downside risks that continue to face the labour market, not only by virtue of the tariffs that have been imposed, but also the uncertainty which continues to cloud the economic outlook, and of course the impacts of the DOGE, Department of Government Efficiency cuts, which really have yet to sort of fully feed in to the data just yet. So I think it's very much a case of a slowdown or a weakening in the labour market having been delayed rather than one having been averted entirely. And I guess we ask ourselves that question again: will it be the next report when all of that weakness finally feeds into the data and finally shows up? Now, of course, in the short term, the market took the data very, very positively indeed. Equities advancing to the upside, the S&P notching a 9th straight daily gain, although neither of us were at the desk for the close. I think we were both watching that from the banks of the River Thames. But I do think the sort of broader takeaway is that neither the US economy, the US labour market, nor equities at large are really out of the woods at this moment in time. But in the here and now, and I know you're going to talk about this momentarily, Ryan, certainly gives the Fed absolutely no need to rush into any sort of rapid policy easing, because for the time being, at least, the US labour market is ticking along just fine.
Yeah, absolutely. And I'm going to channel my inner Lagarde here and say I feel like a
Well, market. You've got a suntan as well.
Yeah, not quite. I'm working on that part. Yeah, I feel like, and the market feels like a bit of a surfer, waiting for that big wave to come. And the same thing with the jobs market. Everyone's gets these jobs reporting on. Is this the one that's going to roll over? Is this the one that's going to show all the government job losses? Is this the one where firms have had enough of tariffs and starting to cut the labour force? And it wasn't. So we're looking like we're having to sit on our surfboards and wait for the next wave to come along. But yeah, overall, again, it's another jobs report that shows the US isn't yet ready to roll over, and that I think is the most important take from all of that. And that's evidence, because I wanted to look at 10-year yields on the back of that, and we saw a bit of weakness in yields in the early part of the week, and then that sort of steadied as we saw this turnaround in stocks and the dollar itself turning around. And yields sort of finished on a bit of a high note after that jobs report, which again just shows the market washing out a bit of that fear. But we're in this waiting game. So we're going to do it all again next month, and we're going to do it after the next piece of big data. By the time you've seen this, we would have had the ISM services number out. The market obviously may have reacted to that. So yeah, we're just in wait and see mode, and everyone else is in the same boat.
Yeah, we absolutely are, and I think it's wait and see mode, but wait and see mode with huge downside risks attached to it. And as a result of that, I think the market will continue to place quite a considerable amount of weight, not just on the non-farm payrolls numbers, which of course the next jobs report is a month away, but also things like the weekly jobless claims data. I mean, we saw last week, for instance, initial claims rose to 240 odd thousand, which is right at the top of the range they've been in for the last sort of 18 months to 2 years. And continuing claims, in the week to the 19th of April, they rose to their highest level since the back end of 2021. So there are signs that things may be starting to soften. And of course, both of those prints are after the survey period for the April jobs data that we were just discussing. But I think the market is going to sort of really be on tenterhooks now every time we get a labour market release out of the United States, whether it be the PMIs, whether it be the jobs data, whether it be the jobless claims figures, almost going, is it now? Is this the one where it really does start to roll over? Because, and I know we discussed this previously, but there is going to be a Thursday afternoon in relatively short order where we have a horrific jobless claims number, and all of a sudden those recession worries are crystallized. It's just a question of when that's going to come, I suppose.
Yeah, I mean, even that jobless claims number, that had some skew apparently in from New York and some seasonality going on there. So, even that potentially wasn't a real number. But I've always said for jobless claims, because it's a weekly number, unless we're sort of trending over 350, 400,000 a week and continuing claims of well over 2 million, it really isn't nothing to get, excited about, even if we do get a tick up into the 1.9 millions as we saw. But you're right in what you say. The market is waiting. It still wants this bad news to come. But I think the price action at the moment is just suggesting, well, while that bad news isn't coming, the market's not prepared to move any further south in certain assets.
Yes, indeed. To coin a horrible market cliche, participants are climbing the wall of worry. And to use another cliche that I absolutely murdered recently, markets can remain irrational longer than you can remain solvent, although I said longer than you can remain sober, which is a version that I actually prefer, I think, given the way things are at the moment. Anyway, speaking of sober market participants, Fed Chair Powell is certainly one of those, and we'll be hearing from him on Wednesday evening.
Yeah, absolutely. And while the Fed are expected to stay unchanged and not do anything, that doesn't mean they'll be snoozing with their feet up. They're watching the economy and how it's performing under Trump. So I'm going to look at quickly just what they've seen last week. So first off, we had the trade deficit jumping, those strong imports playing into things. And that came into what looked like a large inventory build. We saw some of the inventory data building up there as well. Now, that is matched with some GDP sales numbers that were pretty soggy. So that tells you that all that importing is pretty much going into stocks rather than being sold on as yet. Then the GDP was negative, but, even on that, was it minus 0.3%, not collapsing, not falling out of bed, not as bad as the market fears. Then we had housing. We've had some,
Well, and also, sorry to interrupt you, mate, but those two facts are directly linked. We saw a huge surge in imports, so a big drop in net exports because people are front running the tariffs, and that's what then dragged the GDP number lower.
Yeah, exactly. And I was explaining to some of our colleagues, how that GDP works. Sometimes it depends how those imports are counted, whether they've gone on to be produced or whether they've just gone and sat on shelves. And as I say, by the data, it looks like they've just gone and sat on shelves. So then housing market, we've seen all the recent numbers, starts, permits, pending sales, new home sales, some little softness, but certainly no red flags from those numbers. House prices still positive. We are seeing a little bit of easing of the level we've seen previously over the last year or so. Mortgage activity, again, another weekly number, the MBA refinancing and new mortgages. Still positive, but they have been softening a little bit. So something just to keep an eye on, but again, no outright collapses. We know about the consumer confidence data. We saw that again from the conference board numbers, another negative one, higher inflation expectations. So that's trending a bit on those inflation numbers. Jolts eased, so less openings going into the market. But as Fed heads have been telling us, they're seeing a lot of slower hiring, but no firing. So that's, again, you can compare what they're seeing and what they're saying to what the data has been showing. Sector-wise, it's really been manufacturing that's been down in the dumps, but that sector has been weak globally for, 18 months, 2 years now. So obviously, it may get worse due to all this tariff situation. And as witnessed in the ISM last week, pretty much every respondent comment in that report mentioned tariffs as one of their potential reasons why things are turning a bit sour. So we knew about all this stuff already, but it may just get a bit worse. Inflation, that's coming down a bit as well. PCE, Powell, third time on the trot. He's nailed those numbers exactly for both the PCE and the core number, taking the volatility right out of that data point at the moment. So really for the Fed, it's all about the clock. If we get these wonderful trade deals negotiated in short order, well within the you laugh, well within
the biggest and best trade deals that the world has ever seen,
World has ever seen, exactly. Bigger, better, harder, whatever he wants to call them. But if we get those done sort of in short shrifted within the remainder of these 90 days, all the uncertainty that we're seeing likely just becomes a bit of a short-term blip to the economy. But with each week that passes without any deals, the worse it's going to get and the bigger effect and the bigger the hole grows for the US economy needing to climb out of later on. So how does the Fed manage all that? Well, I think they're going to have their own deadlines and red lines that, if crossed, will force them to act on the economy, irrespective of where we are with any trade negotiations. But even then, it probably won't help because it's going to take more than lowering rates to, unlock a gridlock in trade. So I think we get into that situation where they're going to be a bit damned if they do, damned if they don't, in terms of taking rates lower.
Yeah, they are a bit stuck between a rock and a hard place, to be completely honest with you. And rather than the BoE, who often find themselves in that position of their own making, the Fed are in that position thanks to the making of someone else. And as you say, to be completely honest with you, you could set the Fed funds rate at 0 or 1%. But if there's a 145% tariff on imports coming from China, people aren't suddenly going to go and import again just because the Fed funds rate is low. Yeah, fine, it may ease some stresses elsewhere, but it's not a sort of silver bullet. So no, I completely agree with your assessment. I think we'll see very much a sort of status quo decision from the FOMC this week, picking up and flagging the elevated risks of, well, how they're terming it, the dual mandate goals coming into conflict, which is a fancy way of saying stagflation, basically. But certainly they're not going to be drawn on anything in terms of rates anytime soon. And I was thinking about this earlier on. I would say that any cuts before the end of summer are a very, very long shot indeed, in my mind at this point, despite just looking at it, money markets are fully pricing a cut by the July meeting, which feels a little bit punchy.
Yeah, and I saw that last week. We're pricing 100 basis points of cuts by the end of the year, and if you take this week out of the equation, that's 5 meetings to get those cuts done. So markets, again, this is something you need to watch out for, because if markets are getting a little bit too dovish, they might run out of meetings to actually do those cuts in.
Yes, absolutely. And I think markets are probably a little bit dovish, focusing more on the downside growth risks of tariffs as opposed to the upside inflation risks that they bring, which is obviously something the Fed also need to weigh up. But we discussed this before, and this brings us on nicely to the BOE actually, that the job of central banks in the rest of the world is considerably easier than that of the Fed and policymakers in the United States. And I'm talking and talking and talking, hoping that the graphics will move on eventually, but apparently they're not going to. So we may as well just get into the BOE anyway. Oh, there we are, because the MPC is set to deliver their second cut of 2025 on Thursday, which will also mark the fourth rate cut of the cycle. It is pretty much nailed on that bank rates will be cut by 25 basis points to 4.25%. But this has been the case for the BOE for some time now. Bigger question marks will fall around the guidance that they issue accompanying that policy decision, and also the vote split, as in the 9-member Monetary Policy Committee, who votes for what. To tackle that vote split, first of all, I think it's very, very unlikely that anyone prefers rates to remain unchanged at this meeting. I think there is a clear consensus and clear majority on the MPC that they all want to be bringing bank rate lower this time around. The dissent, therefore, is likely to centre on whether any policymakers favour a larger 50 basis point move. External MPC member Dingra has been uber dovish for some time now, focusing on the downside growth risks facing the UK economy, and it does seem likely that she will indeed dissent in favour of that larger rate cut. The question then is, does anyone else join her? Well, we've already had Catherine Mann dissent in favour of a 50 bip cut earlier in the year at the February meeting. That dissent was a very complicated one that was supposedly around sending a signal over forceful policy transmission and the appropriate level that rates should be at, as opposed to any sort of signal on the direction or pace of travel. So I think it's probably anyone's guess what she does. But you also have external member Taylor, who has been sounding quite dovish recently as well. So my money is on a 7-2 vote split in favour of a 25 bip cut, with Dingra and one other dissenting in favour of 50 basis points. Now, the MPC's guidance is also going to be in sharp focus at the May MPC meeting. And the reason for this is because it seems increasingly likely that the bank are going to look to potentially open the door to a faster pace of rate cuts. And this comes off the back of what has been a pretty disastrous slate of economic data here in the UK recently on the growth perspective, with the PMI figures falling to well over 2-year lows across the board, but also amid a much lower and softer than expected inflation profile during the first quarter. Yes, CPI is still well above 2%, and services CPI is near 5%, but both of those are considerably lower than the MPC had expected in their February forecast round, and both of those are also now going to be subject to the disinflationary impulse that we see as a result of tariffs. And Governor Bailey actually gave an interview recently in Washington, D.C., where he was saying that the bank are focused on what he called the growth shock caused by tariffs, as opposed to being focused on the inflation side of the equation. Now, in terms of the bank's guidance, there are two ways that they can tweak things. They have been using the line gradual and careful for quite some time now to describe the pace of policy easing. Very simply, if you take that out or if you change that, then that is a very, very dovish signal to financial markets. The MPC may also look to change the wording around their policy guidance when it comes to the level of restriction. Again, for some time now, they've been saying that policy must remain restrictive for sufficiently long in order to reduce the risk of persistent price pressures within the economy. Again, if you change that, then that is another dovish signal opening the door to a much faster pace of easing. This is also a super Thursday, so not only do we have a press conference from the MPC, we'll also get their latest round of economic forecasts. We should see dovish revisions across the board. There a much lower inflation profile and probably a lower inflation peak as well, below the 3.7% they'd seen previously, a slower pace of economic growth, particularly in the second quarter as a result of the impact of tariffs and a higher unemployment rate stemming from that as well. Now, if we look at money market pricing, the sterling OIS curve sees bank rate ending the year at about 3.5%. As we are now, we're at 4.5%, so 100 basis points of cuts effectively. In my mind, given the data here in the UK, given how tariffs have shifted the outlook, and given what we've heard from Governor Bailey recently, I'm going to say that feels about fair. And at this point, I can see them going May, June, August, September, and then taking a pause in September when we're back at 3.5%, providing, of course, that the inflation side of the equation behaves itself. But they're going to be doving it up on Threadneedle Street, I would imagine.
Yeah, no, I think you've got to take central banks on. We've been speaking how the central bank trade isn't anything right now with all this geopolitics going on. But I think you still have to keep an eye on things. And the banks like the Bank of England, the Fed, RBA, who have still got rates well above 4%, you have to take it as if you didn't have all this Trump stuff, what would they be doing with rates on the economy as it stands? And like you said at the start, likely the BoE will be cutting at a much faster rate. So you've got to keep that in the back of your mind. I think they're also probably going to take a leaf out the Bank of Canada's book and saying, here are our forecasts, but here's 100 excuses why we're not going to even trust our own forecasts.
Well, they should do that in normal times, to be completely honest with
you. and that goes for the data as well, because the data is a load of old codswallop at the moment, to put it politely. So yeah, whatever forecast they give, it's going to be heavily caveated with, but this is based on something other, Trump, whatever. If that doesn't happen, this might happen, and all that sort of thing. So it's probably a meeting where they say, here's our forecast, but don't listen to them, really. As you say, not that many people do in the first place. But yeah, the vote's going to be pretty interesting. Again, I don't know, 7-2 probably. We may go a 6-3 because there's going to be enough people there who think, we don't know what's going on, trade wars, it could bring inflation, and we know how the UK gets affected by inflation pretty quickly than some countries, and how inflation tends to remain a bit stickier here than it does elsewhere. So yeah, I think it's going to be all around the houses, and we're none the wiser when it's finished.
Well, that sums up pretty much every central bank meeting ever, to be completely honest with you. The one last point I would make on the BoE, just in terms of the idea of consecutive cuts, which is my base case now. The vote split is also important for gauging the likelihood of that, because we have a situation at the moment where Dingra is probably going to vote for a rate cut no matter what happens at every meeting. And we have the 5 internal members of the MPC. So that is the governor himself, the 3 deputies, and chief economist Hugh Pill, who generally, not always, but generally vote as a group. Now, what that means is you've got, at the governor's whim, 6 members of the MPC who will probably vote for a rate cut whenever he wants them to. So that means that actually, from a sort of political perspective and from a sort of management perspective, actually Andrew Bailey has a very, very strong grip on where the MPC will go. And the bottom line is, if he wants a rate cut, he is going to get a rate cut at whatever meeting he wants that cut. The dissent is not going to be such that it is a sort of blocking dissent. There are enough members on the MPC now who will be able and willing to vote for rate cuts as and when it is deemed that they are to be delivered. So I think that's something worth bearing in mind. Anyway, that's enough waffle about central banks. We can talk about something else now, I suppose.
Yeah, I'm going to talk about the art of pricing in, as it's called, and really have we turned the corner in regards to this recent round of negative pricing, we call it, from all the Trump stuff. Pricing it's the same we use a lot in trading, about what's priced in. We use it for central bank expectations, we use it for economic data, and obviously politics. Now, the art of pricing in is constantly working out whether a market has fully assessed and therefore priced any particular risk event, whatever it may be. So why is this important? It's important for our trading because understanding the process of market pricing helps you to understand how you should trade it. Now, for the last few months, we've had a lot of fear, but the pricing can only go on for so long before the market finishes making that adjustment to whatever news it's trading. And then it often needs a new catalyst to keep going. You've seen this exact effect happening in stocks. We do not have one single trade deal that has seen a pen put to paper, yet the market has rallied significantly. The dollar has also turned from looking very bearish to a bit more stable. Now, does that mean we're out the woods? Absolutely not. But the price moves over the last couple of weeks show that the market is perhaps finished pricing in all the bad news for now. Now, it's very easy for traders to get stuck in a commentary narrative and ignore the prices when they move against that narrative. Now, commentary at the moment is still very negative. So many traders also have been shorting stocks on rallies, doing the same thing for the dollar, staying short on the dollar because they think it's still going to keep going down. Well, right now, the market is saying otherwise. And that's what you need to pay attention to. So for something like stocks on the dollar to fall back down, it needs something fresh. Now, it may well get that if we don't see any trade deals within the 90-day deadline, or that looks like it's going to produce nothing. Conversely, this bounce doesn't mean everything is rosy too, and we will probably have an upside limit at some point. It's almost like a Newton's cradle effect, and if you identify the price action in that, you can then define how to trade it. So if you're looking at something like the S&P, without any fresh news, we will probably find a top, somewhere pretty soon, and then maybe consolidate a little bit until we get the next round of big news, whether it's good, bad, or ugly. So I've drawn a little pattern on the chart there. That's what I'm sort of maybe expecting.
What on earth that was?
That little squiggle, yeah, it's my highly intelligent metric that I use, a little pen and squiggle. So yeah, look for something where we maybe hit a high, then we have a little pullback, then we try that high again. And if you find that we can't get through that high, that then tells me, okay, we've priced all the bad news on the downside, we've had a bit of relief, but the market's saying, okay, that's as far as we're going to go. Now we're going to sort of wait and see what happens next, and we'd probably do a bit of ranging. And that's where you sort of get your little flags appearing and your pennants and whatever, wedges. So I'm expecting a bit of that if we get no fresh news coming out. Obviously, if we do, then the market will move on the back of it.
Indeed. Right then, Pablo Picasso, you were after a market-related bet last week. Here we go. The S&P future, the all-time high, I've just been Googling it here, is about 61.50. What trades first, 5,000 or a new record high?
5,000 or a new record high. I'm going to say new record high.
I'm glad you said that, because I'm more than happy to take the other side of that, and we will.
Of course you are.
We've got video evidence there, so we'll have a lunch on that or something similar. But on a more, there we go. That's that agreed. But on a more serious note, it is a very, very good point, and I think there is certainly an increasing school of thought or narrative that says we are sort of past the peak of tariff-related noise, at least from a market perspective. It's now a case of investors saying, okay, well, what impact is this going to have on the economy, or when, or indeed if those trade deals are going to be struck, et cetera, et cetera, et cetera. The story has sort of evolved from one of, oh my God, tariffs, it's all very, very uncertain, get out of any risky position at all, to one where marginally calmer heads are prevailing. But as you rightly say, we are certainly not out of the woods, particularly on the trade front. Trump now talking about a 100% tariff on films not made in Hollywood. Yes, that sounds utterly ridiculous, but it's important, because is it a sign that the trade war is broadening out and now encompassing services and not just goods? And if indeed it is, then that is going to be yet another headwind for the US economy to deal with. But yeah, I'll go and find a nice Michelin star restaurant now in that case.
Can I change my mind?
No, too late. It's on camera now. There's no getting away from it. Right.
Okay. I'm off. I'm going to start saving.
I'll do our plays of the day on my own then in that case.
Yeah.
Right then, our plays of the day this week, I am going to be looking at gold. Now, don't worry, I haven't gone mad. I know this is the same chart I showed you last week, just with 5 extra bars on it. But I thought it'd be worth revisiting the idea, because spot gold remains, well, just to the upside actually as I speak, of this $3,200 to $3,300 region, which we flagged as key support last week. Now, there is, of course, still a significant case out there for haven demand, as we alluded to a moment ago. But I do think it's just worth flagging that buyers out of Asia appear to have somewhat gone into hiding over the last week or so. Now, of course, China has been closed, but this is just a little bit of a warning sign, given how much of the recent rally has been fueled by demand out of Asia. If buying flows there are starting to dry up, then that is something certainly worth considering. Nevertheless, for me, I am still happy to be buying on dips here. I think $3,200 an ounce is my line in the sand to the downside. A close below which would likely give the bears the upper hand, would make me reconsider that view, and would put the bearish target in view, which is the 50-day moving average, which is down at around $3,100 an ounce. But for the time being, gold is, well, starting to find its shine once more as the new week gets underway, and perhaps bullion salad days are coming back once again. Ryan, speaking of Asia, you're going for dollar China this week.
I thought you were going to get through your whole play of the day without a silly pun, but obviously not.
Never.
You had to slip one in there in the end. Oh, God, it's like buses. You wait for one and then you get two at once. Anyway, I'm looking at dollar China, and my last topic was speaking about how things get repriced, and this is a pair that's undergoing just that. There's more signs of easing tensions between Trump and China. It's seen CNH, the one, gaining quite significantly, but again, we're no closer to a deal than we were before. So I think if this carries on much further, I'm going to look to maybe start buying it if there's no real news to match this moves at the moment. I also think that while trade is a big deal, there's more fights to come with China even after any trade deal was negotiated, meaning potentially more weakness for the yuan. So this is a trade I was actually looking at last week. I was eyeing the sort of 720, 721 level as a potential place to maybe start nibbling some longs. But as we've already broken there, I'm leaving that well alone, and I'm going to sort of set my sights a bit lower. So 711, 712 is looking like the area that I want to start getting in at. We've got a couple of old fibs there, and some new fibs too. So I'm a bit of a zone for me as well. So I'm going to start looking there to maybe picking up some longs and see if the news plays ball.
Good stuff. Certainly yuan to watch there. In any case, that does bring us to the end of another show while Ryan has some sort of nervous breakdown there. Thank you very much, as always, to him for joining me. Thank you also to our producer, Kyriakos, as well, who has decided to actually turn up this week, which makes a nice change. In any case, hopefully you've enjoyed the show. If you have, do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, how you're viewing everything that's going on at the moment. And the three of us will be back with another episode of the Trade-Off this time next week. Thanks as always for watching. Goodbye for now.